you'll know that I like to start with a quote. And this week's quote was, "All growth depends on activity. There is no development, physically or intellectually, without effort, and effort means work." And that was Calvin Coolidge, the 30th US president. So before I get started, I just want to give you a reminder about the next Property Business Workshop, Thursday the 16th of January 2025. Rod Turner and I covering productivity, planning and financial accounting and bookkeeping. Why? Because we constantly see property businesses struggling with appropriate financial reporting, accounting and bookkeeping, and making the same mistakes time and time again. This is to help get a complete handle on the financial performance of your company or group when you aren't at a level yet where you can afford a CFO or financial controller. Set up correctly, once, and then you iterate from there. As always, it'll be an action-packed, content-filled day, which will stand alone in helping to advance your understanding as a property business owner. The link is live, and there's a few super early bird tickets which have got a genuine 25% face value discount still left at bit.ly/PBWFIVE. So this week was the first week for quite a few without a near seismic event in the macroeconomic world. But how are things settling down? We know, for example, quite a lot more about rates at this point than we did in the immediate aftermath of the budget or the re-election of Mr. Trump. Bit more on that lot later. It was also the week in the quarter where I got to attend the Bank of England briefing for the Midlands, and that always leaves me with some valuable insights and also makes me think that just a little bit more. I'll have to dive into the Chancellor's Mansion House speech as well, because that can't be resisted. So into my usual cycle, Chris Watkin asked himself that question one more time: what is currently happening in the UK property market? And this report was from the week containing the base rate cut, where many poor, unsuspecting lambs would have then expected mortgage rates to drop. Although if they're watching the headlines, they'll know this is not going to happen, not in the short term anyway. And in fact, the big banks have been spending the week putting rates up. Chris, the property stats guru, made my week this week when he added me to a secret distribution list for his property market analysis in real time. What a gent he is, and a great service he provides to the property industry. He reports on the UK portal data, which is aggregated for him by 20EA on a weekly basis. I love real-time, or as near real-time as possible, snapshots and pictures of the market that we can piece together. There's nothing better for staying informed. Well, we have to analyse what has happened, but only really so we can meaningfully try to predict what will happen. Listings took a bump up to 29.5k last week. That's rare for this time of year. What's behind it? Budgets smelling like unfinished business? A few savvy landlords expecting another CGT rise next year, having felt like they might have dodged a bullet this time round? Well, they could be right. Of course, they're still going to lose a bit thanks to that 5% stamp if they're selling to other landlords, but there we go. But you or your company can get rent forever, whereas you only pay CGT once per property anyway. The market still looks healthy enough though. This week saw the sub 4% mortgage deals evaporate for the owner-occupiers, but the stress test level is the one to watch. As long as we can stay near 6% and ideally 5.5%, there isn't much to worry about, as people really have started getting used to the normalised rate of interest now. We've had about 18 months to get used to it, let's face it. So sold subject to contract stayed at 24,000 this week, far higher than the same week in 2023, 17% higher, and we're even further ahead of the pre-COVID averages than we have been. We're 8.2% above the number of sold subject to contracts in the average between 2017 and 2019 in the year to date. The fall throughs ticked up a bit more, 28.7%, so about 2 in 7. That's up from the 1 in 4 that we have been seeing, which also represents the long-term average. The budget didn't have a catastrophic effect, but Chris estimates that it explains about 600 fall-throughs. Remember, the fall-through rate was 40% for 2 months after the Truss Kwarteng mess of 2022. Net sales are ahead of 2022's number for the rest of the year, there's no doubt about that. The only year with more net sales, which is gross sales minus fall-throughs of course, was 2021. Remember how bad those last 2 months of 2022 were though? A healthy print on the year and 5.7% ahead of the pre-pandemic average now. Also remember about these newly introduced or reintroduced stamp duty bumps rather than cliff edges, between 125 and 250 and between 300 and 425 for the first time buyers as well. As I said last week, they'll nudge behaviour the other way around in the first time and secondary markets of course in Q1 of next year. and possibly before Christmas for the very well organised. Everyone paying over 125k is paying the extra, apart from first-time buyers, in the 125 to 250 band. And first-time buyers are probably the most motivated because that marginal band between 300 and 425 is 5%. And so £7,500 of extra cash to find, or borrow from the bank of mum and dad, will force a few transactions through before April the 1st, 2025. You would expect from the point which we are starting the impact to be more volume before the 1st of April and then less volume after as the market adjusts to the transition, with future volume dependent on the pace of rate changes. But use this wisely. Don't compete if there's a huge scrum in Q1. Stick to your guns with a big effort in Q2 at the beginning to get the reductions that will pay you that stamp duty difference back 3 times over. That's what I've done in the past in similar situations. And remember what this also means for anyone disposing of any stock, right? List your sales wisely, now or soon. Certainly prepare to list on Boxing Day and get carried away with the usual hype, or make an impact on the first weekend of the new year after the kids are back to school. Depends on what you're selling. Line up decent lawyers on your side as well. It does look like there'll still be plenty of stock on the market. As we near the November auctions, I'm still seeing tumbleweed for the vendors. There's the same money out there for the right lots and bargains, of course, but many buyers are going to be looking to load the entire new extra 2% onto the vendor to make their already tight margins hold up. We snagged a lot this week at 80k when we would happily have paid 95. End value 160 without much work to be done. Now, this simply never happens this easily. Look, it's an overnight success of many hard years' work, absolutely, but it's been the pattern the last 3 months, and we don't see it often. December looks again likely to be very quiet in the investment market, and 1 week further on from the budget, it's exactly what we're hearing and seeing in terms of numbers of people at auction viewings, numbers of calls we're getting from agents, desperate to move stock on. One more takeaway from the real-time desk though. October sold subject to contract figures showed £346 a foot being achieved. That's about 1.5% ahead of July, in spite of the overall bearishness. Things are moving north on pricing. My 5% for the year looks a pretty reasonable stab, although the ONS land reg might print closer to 4% instead. I'm going to be really close. October numbers will hit the ONS about March time or so. So, stop. Macro time. This is one of those weeks that selects itself. Unemployment and the labour market report, we have to talk about it. GDP growth, of course, made such a big deal out of it in the election campaign. The RICS house price balance and their residential monthly report. Perhaps no surprises for regulars here, but still worth a look as always to see what the surveyors are seeing and saying. And then we close with the gilts and swaps, as you'll know, where we will close for some time to come. So the labour market report, we had a few headlines around this week. The employment figures as a whole have been cast into doubt for at least a year now, and I've mentioned it a few times. It's one reason not to get carried away, or not to get too carried away, with a reading like this week. However, as always, the reporting on the why is lacklustre and lacking detail or the correct answer. For those who don't follow the macro stats closely, we swung from 4% to 4.3% unemployment, in what's a really violent swing for a non-recessionary environment. And no, don't start. I know they aren't doing a great job, but we really aren't in recessionary territory here. This is nothing to do with the actual budget, because that was at the end of October, but could obviously be argued to be something to do with the budget run-up, of course. The PMIs have been more bearish, especially since Starmer's doom and gloom prep speech in early September, but not to the tune of us going backwards. It isn't just poor reporting and collation of data, though, or the lack of participation in important employment surveys that firms used to participate in with a lot more vigour before COVID and have really fallen out of love with and don't return their surveys on a timely basis anymore. There is another reason, as always, that isn't being spoken about. Always remember as well, we're looking backwards, only a bit, but September feels like a long time ago in terms of this particular metric, and not forwards. Still, let's get into the meat of the ONS report. Here's the rub. When we remove ourselves from the headlines and we ask ourselves what percentage of the potential workforce, as defined, is employed, we get to 74.8%. That's about the same as a year ago, and that's improved in the previous quarter. Because remember, we had a really relatively rough second half of 2023, according to all the stats, with a technical recession. Then we look at the unemployed. Now, of course, that's where the headlines start. That rate has moved upwards, month on month, quarter on quarter, and year on year, but clearly not at the expense of employment as a percentage of the workforce. Now that only leaves us with inactivity, that much lamented problem standing out in the UK post-COVID. That question gets asked, why so many more still inactive compared to our European neighbours, for example? And the answer is a mixture of the health of the population, both physically and mentally. Things like relative obesity are an issue, but not a sole explanation. And the ease at which the population has been able to opt out of work due to under-tested benefits. The benefits system has been, once again, becoming the problem it was before 2010. This isn't a political point at the change of government, though, because the recent issues have absolutely been bred and created by the blue boys and girls. There was talk of sorting this out post hoc, late to the party, once the figures were known to Mr Sunak, but then the exit door beckoned, of course. The new administration will have to, at the very least, get their head around the figures and the ballooning nature of the problem fast. Water runs downhill, and it's my belief that people behave as they're incentivised. If it's viable, there's a decent slice of the population who would rather not work. They don't see the upsides in having purpose, structure, being a part of a team and a network. They don't bear sole responsibility for that either. Some places are just not very nice to work for or in. Then you start on what career aspirations that social media drives in the teenage generation, who are monopolised by the dopamine factories of TikTok and the rest, and you've got a problem. A problem that is likely only solved by benefits austerity. Sounds quite political for me. I am subject to ideology like anyone else. My belief, as I said above, is that people behave as they're incentivised. That doesn't feel in any way like a leap of faith to me. It seems like a fact, but that's how beliefs work. Some would likely prefer to believe that society is to blame. The truth lies somewhere between those spectra, I have no doubt, but I'm simply speaking from what I've observed over the years. There's also been a genuine long-term sickness problem, of course, but as I say, we've moved a long way out of line with the rest of the developed world. Nevertheless, that long-term sickness problem is being addressed. We created another one here with NHS funding, although money alone won't solve the problems, as we all know, but it will have an impact. The current outcome looks like people can come off the sick or awaiting appropriate elective medical treatment list and straight onto the unemployment list, because lists have peaked about a year ago now for elective treatment, but really haven't come down a long way. They're about 200,000 off the peak of 7.77 million. And there's lots left to do there. And I do believe that the Labour government will continue that trend and make progress. So where have we got to? 0.3% of the population of working age, instead of being inactive, are now actively seeking work, but they don't have it yet. Now, it's not quite as stark as all of that, because that's not the same 0.3% of people, but that's the impact on the figures. I hope that makes sense. The numbers are the same percentage are employed, and unemployment actually looks just like a side effect of getting people back off the inactivity list. And I think we can expect more of this. Vacancies are dropping, although we still have 831,000. They remain above pre-pandemic levels, but it is getting close. They dropped 4% last quarter, which is quite a rate year on year. None of this is budget result driven, of course, although some of it is inevitably budget speculation driven. The natural reaction has been, for firms and individuals, to wait and see. The best opportunities I've ever seen are when everyone else is waiting and seeing. And that's exactly why we've been so very busy in acquisitions over the past couple of months and continue to be so. If the significant drives in the NHS, plus improved morale of staff, which is key, but it needs to happen rather than just be a theoretical, are successful, then expect unemployment to go up a fair bit more. This is a nuanced reason that the Labour Party will need to communicate, because it's fuel to the fire for the Conservatives. They won't want to explain why, they'll just want to point at the numbers, which is quite easy to do if you point at the right ones to make your relevant points. Now, we know from the PMI analysis that a lot of this has been budget driven. Companies have been citing it left, right and centre, and barely a week has gone by since September where I haven't been quoting it like a broken record. But that's been everywhere. The November PMI reports will be the most interesting for a while, even though I think we know what they will say. Hiring freezes, concerns over inflation due to further increasing staff costs, and an inevitability of price rises being forced through supply chains. The positives from the labour market report, though: inflation that was well under control in Q2 And a drop thanks to energy price normalisation, remember, meant that regular pay, once adjusted for CPIH, including housing costs, was up 1.9% in real terms, annualised. Healthy enough for the workforce? How will it hold up over the next couple of years? We probably need one more topic before moving on to the next one, and that is the absolute key, the holy grail of economic growth: productivity. There has been this mystery since the financial crisis as to why UK productivity has stuttered so much. Although I think the answers are there. A lack of capital investment. Right, AI plus more expensive people might well encourage some, perversely. A big increase in the denominator in recent years. That's the cost of everything, including people. There are several other theories too. An ONS report on productivity was released this week as well. The estimate is that output per hour worked decreased by 1.8% in the past year. Other sources that the ONS is considering, because their labour force survey data isn't that reliable at all since the pandemic, as I said before, suggests actually output is up 0.5% on the year, which is passable. That's per hour worked. That's passable, but not great. It's a lot better than down 1.8 though. The problem is the official figure is down, and that's the one that will be broadcasted around and will weigh on investment decisions and the likes when multinationals consider UK or not UK for an investment. The average earnings increase year on year nibbled down to 4.8%, which is still not low by any standards. Enough, anyway, to the GDP growth figures. Shall we sensationalise it and just blame the Labour Party? Growth half of what was predicted? Well, none of that is quite true, but let's just try and stick to the facts. The initial thoughts around Q3 several months ago were about 0.3% growth. That's where I was. There was one point where I was bullish enough to be at 0.4% growth before I started revising my forecast downwards once I saw and heard what was coming out of the senior ministers' mouths. This was on the back of a decent run in the economy and also the inflation dividend. Always remember, GDP growth is adjusted for inflation. When inflation dips significantly, that's a big following wind for growth. And likewise, I said a number of times, the economy did incredibly well in late 2022 and 2023 to even keep pace with inflation. It was a miracle, really. The 0.1% for the quarter was a disappointment because we had 0.2% in August on its own. That meant September went backwards, which it did by 0.1%. Elections are allowed and always create a little bit of a blip. There's no two ways about it. As I said before, give people a reason to procrastinate and they will. It's just the way it goes. It's a limp and weak performance driven, of course, by the services industry, which also grew 0.1% on the quarter. But let's go a bit deeper and get under the skin of it. We're 1% ahead of a year ago, apparently, which feels about right because we were down 0.3 in Q4 of 2023, and we're up about 1.4 since then, when you look at the current figures for 2024. Now, I say current because they do have a tendency to get revised. When you get to the breakdown, yes, services dominate, but don't miss construction expanding by 0.8% on the quarter versus production falling 0.2. Construction only makes up a small percentage, but of course is of greater interest to us. The bit that makes a real difference to the people, real GDP per head or per capita, is flat compared to a year ago and 0.1% down on the quarter. Conclusion, we went backwards per head and only grew thanks to migration having more people. GDP per capita fell by a pretty massive 0.6% in the last quarter of 2023, so that will drop out of the figures this quarter, and it really doesn't feel that bad, does it? That's not what gets you re-elected though. Never forget that much vaunted feel-good factor. Early days yet, of course, but one of the key reasons I think why the Tories got kicked out in the last election. So, on the services side, nothing did particularly badly, but business to business stagnated. That does feel like budgetary concerns, and that's what all the big businesses were saying in the reports and the surveys on the ground. Consumer facing, a smaller component, increased by 0.5% as the cost of living crisis eased yet further. The press don't tend to comb through these reports for headlines. If they did, they might point out that the 0.9% decline in water supply, sewerage, waste management and remediation activities, having been told all this was going to get sorted out by the new government, that's not the best start. Still, construction, new work up 2% in the quarter, maintenance repairs down 0.6%. Infrastructure new work up 2.8%, which is great news. Private housing repair and maintenance down by 5.8%. Now, I know there's still a huge groundswell of opinion that landlords are moaning and it's all fuss about nothing in the PRS, but I can categorically tell you that all indicators are showing that to be incorrect. And there's a massive shock coming when the figures finally come out. Pencil in about December 2025, ridiculously enough. When repair and maintenance moves downwards like that, it's very often a sign that people have made decisions to sell and they're keeping it very tight before sale. I've seen it time and time again. It's a natural reaction. Well, we don't need to fix it, let's just put a plaster over it and cover it up if we're selling it. That sort of attitude. There's seasonal factors as well, of course. Build when the sun is shining, although did it in Q3? And then do the indoor work over the winter. So let's keep a close eye on this number. But having said that, when you're comparing it to the previous quarter, which was quarter 2, the other half of the supposedly decent UK weather, then there's no real reason for a seasonal drop, is there? Apart from it being August, I suppose. One more observation from the report too. Services exports, which have been doing well, fell by 1% in the previous quarter. Some of this might have been the stronger pound, which peaked at the end of September, but again looks strong, particularly compared to the euro, who are not having the same issues with their bond yields and now growing at a much faster pace than the UK. Growing trading partners are a good thing, although they make our government look bad, of course, if the trend continues. Even Germany put in a positive Q3, which they will hope puts an end to the absolute treacle they've been in for the past couple of years. Italy stalled, but France roared and the US charged forward. And the attitude around the US, for those who are hanging around for Trump V2, is very positive. Over-optimistic in my opinion, but let's see rather than prejudge. Enough stats, because you must have stats flagged by now, I hear you say. Never. On to the RICS house price balance and the temperature in the housing market according to the professionals, the residential market survey. What's the strapline? Sales market activity continues to rise steadily. Recent trends positive. New buyer inquiries positive. Headline house price growth gradually gaining momentum. Sounds good to me. And also expectations of a brighter picture for activity being sustained over the near term. Now, I don't think too many of the RICS worry too much about the bond yields and swaps. We'll get onto those in a moment. The last few weeks haven't been good though, and expect mortgage buyers to have lost about 0.5%. We also know the market isn't as sensitive to this as we would all think, and although it doesn't help, it isn't going to derail the train anytime soon. The balance figures, remember, are the positives minus the negatives in the report. So the near-term sales expectations at plus 34 mean that if there were 100 people in the sample, 67 are positive and 33 are negative about near-term sales expectations. 67 minus 33 is 34, and that's the print. So plus 36% see sales volumes rising over the next 12 months as well. New instructions are still positive at plus 14%. Sales agreed are rising less quickly, but are still positive at plus 9%. This is the third positive print in a row for this statistic that has been below zero for 2 years nearly. Now I think we need a fair bit of caution here because this was all before the budget and understanding what was going to happen to stamp duty, and rarely do stamp duty hikes lead to a rise in overall transaction volumes. They might lead to a rise in transaction volumes up until the cliff edge, but when you get to the cliff edge or the speed bump as I've described it this time round, then you're going to see volumes fall. Right, so transactions are brought forward, but then they fall away. And over the longer term, you'd expect fewer second home market transactions at 5% stamp than at 3% stamp. It's just how transfer pricing, markets and economics works. So the house price statistic, the big one, printed plus 16%, which is the highest print for 2 years since September 2022. The near-term expectations for prices went to plus 20% over the next 3 months. The rental market figures represented continued carnage. Plus 19% on tenant demand, minus 29% on landlord instructions, the most negative reading since the end of 2021, and plus 33% expect rental prices to drive higher over the coming 3 months. The rest aren't paying attention, or must be in a funny old part of the UK. And just look at what a great job Labour are doing in Wales. When you see the rent expectations regional chart that I shared in this week's image, it was somewhere near plus 80% of people expecting rent rises in the next 3 months in Wales. Anyway, gilts and swaps, let's go. The 5-year UK gilt opened the week at a yield of 4.347% and closed at 4.33. Flat. Well, it closed Thursday at 4.365, having butted heads at 4.45 for the week, testing a level that does just look too high. Looks like my Christmas bonus prediction will have to be more at the high end of my new realistic trading range of 3.75% to 4.25%. Although I've got less conviction on that range right now than I had on my lower range at the start of this year. There aren't a lot of forces pushing it down below 4.25% at the moment. The gap down to the swap rates, which has been an inexplicable 30 basis points for some weeks now, was preserved and even increased on the swaps. 4.009 was the last 5-year SONIA swap traded on Friday afternoon, and that for the second week running is 32 basis points lower than the gilt close. Long may that last. It still compares very favourably from the numbers a year ago that were 0.2% higher, and keeps the mortgage rate with no fee at 6%. And investment grade gross yields, as I see them, which is a dangerous concept. I dislike gross yields, but I talk about them because the whole of the rest of the industry talks about them, especially if you've got to think about service charges or bills included, HMO, things like that. Those yields have to be higher, of course, but investment grade gross yields are 8.5% plus. The same lesson I've been preaching for the last couple of years bears out. Those with net yields pre-finance at or above 6% are okay. Those without, prepare to keep subbing your portfolios if you want to hold on to them, or get active with your asset management to force yields, restructure, sell, etc., or accept terrible returns on equity. You're fine to price in a 10% rent rise over the next couple of years, as long as there's affordability in your area. But there will be capital growth, so your net yield won't just improve by 10%, more likely to be between 3 and 5% improvements on the rent side of things. Not in terms of the yield overall, I should be clear. So we're not going to go from 8 to 18. We're going to go from 8 to 8.8, let's say, is what I'm saying. So prepare for the deep dive. Insights from the Bank of England regional meeting, the longer term impact on rates, and the Chancellor's Mansion House speech. I'm going to start where I ended that meeting, with a question. We've got to the stage now where the local rep always jokes I'm going to ask a difficult question, avoids me for the first couple of questions, and then gets round to mine, and then usually gives a pretty solid and robust answer. My question this month is a bit more of a comment and hopefully gives some reasons to be cheerful. I said last week there's a bit of an error going on in terms of what people are interpreting the recent fiscal policy changes as doing in the budget. We need to remember C plus I plus G plus X minus M. Sorry for those who didn't do economics at GCSE and above, but it's a nice easy formula for the national income. C is consumption, which has struggled since the pandemic. I is investment. The Chancellor contends she's found a way to boost it. I've got my own take on that. G is government spending. Now, no one can deny this is growing in real terms. And then X minus M is net exports. Now, there's issues there, of course. So remember, economists are usually fairly simple people. Consumption is the biggest part of our national income, and it's quite easy to understand in many ways. People have money from work, benefits, and their own investments. They only do one of two things with it. They spend it, or they save it. The savings ratio is basically a concept that measures how much of their disposable income that a household saves on average. Now, we know averages are a dangerous concept, of course. Dangerous, but not useless. How do we feel about savings at the macro level? Well, they're not great, to be honest. If you save at 4% and pay a 20% tax on that savings income, the government still gets their little slice. If you spend it instead, the government gets a 1/6 slice most of the time, that's VAT, and then the money trickles down the supply chain and that money gets spent again and again and again, and this is called the multiplier effect, right? It creates much more economic activity and contributes much more to GDP when it's spent rather than being saved. Immediately before the pandemic, we saved about 5% of our disposable income as a nation. Now, before 2019, it was a little bit higher than that. The US has an even lower savings rate as a more aggressive consumption society. We hit 10% this year. Why? Well, here's where I take issue with the bank. The book dictates that people are seduced into saving because of the rate of return. Empirical evidence throws this into question. For example, in Japan, with a 0 or negative savings rate for decades before the recent COVID-inspired inflation even getting to them and then moving their interest rates up from 0, people still saved. Savings, or non-consumption, is about putting money aside for future events first and foremost. Of course, the rate has an impact, but it is, in my book anyway, a lot lower impact than is given credit for. There's the key though. Saving for future events. What has there been to save for? Of course, the subject matter which I'm obsessed with, housing. The cost of the roof over the head has been rising, and some would fairly say rocketing. Your mortgage might well at some points have looked like it was going up by 50 or 60% per month in terms of payments. Now things have calmed down largely since then, but your interest-only mortgages might have gone up. My record was 800% on an old interest-only one that was at base plus a very small margin. The payment went from 100 to 900 a month. Good job the rent still left some margin, and I had many years of clover from that one base rate tracker that I had from pre-2008. The average percentage, as I calculated some months back, looked more like about 90% in terms of the increase. These are huge rises, of course, far above inflation. Unlike many other price rises, there's also a heads up, as an average household, depending on age here, has one mortgage, and it's the biggest payment they make each month. They keep a pretty tight eye on it. So now the rest of the logic. If you had a 2-year mortgage in 2022, you're at the end of that cheap money cycle. It's expired by now. There will be a few who had mortgage offers from September that held up and maybe completed in December 2022 or maybe even early 2023, and they'll be trailing off their mortgage rate in the next 6 to 12 weeks. But then that's really the end of the 2-year cheap money. Now the 5-year money, hopefully it's relatively easy to see. We're only about 40% of the way through that cycle because we're 2 years into it, and 2/5 is 40%. Every offer pre-September 2022 was pretty darn cheap by today's standards. That sword of Damocles hangs over many households until it does drop off. The Bank of England's own data, whether correct or not, suggests that people cut their consumption and thus increase savings by about 30% of the implied increase in rates, and by about 60% of the actual monetary increase in rates when they actually get to their new rate. So where does the rest come from? Well, income rises for households in the interim, which have been reasonably generous for years now, or forced income rises from second jobs and the likes. This is the cost of ZIRP, the zero interest rate policy, to the households. It's a slow carbon monoxide style grip on the household finances. It manifests itself in that higher savings rate, and in my opinion, and it's only opinion, not science here, it explains a good 70 to 80% of the change in the savings rate. This is also all over within 3 more years, as I've said, and there won't be much more reason for households not to return to normal consumption levels. But that in itself has stunted growth for the past 2 years. Nobody talks about this. Now this is alongside the other factors such as high inflation, cost of living crisis, etc. It's part of the cost of living crisis, and the biggest part, I would argue, because we saw big things about food inflation being 30%. Well, I get that, but food is making up maybe 12%-ish of a household's consumption these days, according to the ONS basket for inflation. So when it goes up 30%, it hurts. But mortgage payments are making up, up to, as you'll know, and certainly rent payments in London are making up sometimes 50% of people's income. So it's a much bigger effect than food inflation, and it went up by more as a percentage. So then we've got the government spending more. The old "you can't tax your way to growth" argument does resonate with me, but if you tax 40 billion quid extra and spend as a government 80 billion quid extra, then I'm afraid, folks, that 40 billion net difference absolutely is the extra growth the way things are measured, although you still need to adjust for inflation. But a lot of the government spending is talked about in real terms rather than nominal terms. You might impact investment negatively. The rhetoric has all been around increasing it, and rhetoric and action in this government are surely disconnected, as you can see. But all the construction figures have shown improved infrastructure investment, for example, which again is boosting the national income. Imports are more of a problem, even though some fairly outrageous claims have been made in terms of the quantum of the effect of Mr. Trump's favourite word, tariffs. 0.5% cost to our GDP, The Guardian quoted from a credible economic source. I'm not sure about it being that high, or whether the UK will get a bit of a deal there as an old mate. Maybe they'll support the old Brexit buddy. Who knows? So we need to wait and see. It doesn't help us, but I'd still be stunned if we took a 0.5% growth haircut on the back of it. X minus M, exports minus imports, is always the smallest part of the formula anyway in the vast majority of developed economies. So there's actually a case over this Parliament for better than expected growth, in my opinion. But please note, this isn't the same as me suggesting the government is doing a good job. The growth figures at the moment speak for themselves, hence the name of this week's piece. I called it Growth, Oops. But actually the runway, shocks aside, looks pretty good. Then the shock we have got coming next April takes a couple of years to play out, according to the Bank of England. We see some rising unemployment, not necessarily a bad thing, as long as you don't lose your job or your tenants don't. Unproductive companies and workers do need to be cut out of the loop. Go broke, retrain, reskill, and do something more productive. Units need to be repurposed, increasing GDP and improving the quality of offering of commercial and residential stock. That's the capitalist game, and the market largely works, or it works better than all the alternatives, is often the way that it's framed. We might well be more efficient at 4.5% unemployment and see some productivity gains. You never know. As per the above labour market analysis, it's difficult to trust the figures at the moment anyway, but Labour are currently keeping up their track record of increasing unemployment in every stretch in government that they've ever done. Very few will discuss whether that could be a good thing. So, that, much shorter than all that, my question was, that was all my thoughts put together, was my commentary on Thursday. And my question for the rep was really, what do you think about all of that? He suggested I could well be right, and that my thoughts were largely captured in one of the upside scenarios that the bank considers. Now, I'm not often accused of being overly bullish, and this wasn't one of those times, but hopefully you can see I'm highlighting a scenario that I think is more than 50% likely to play out, whereas the bank thinks it's an alternative scenario rather than a base case one. Now, I hope I'm right for the sake of the country. We need some positivity, we need some good results, of course, and we need the rising tide to attempt to lift all boats. I carried out a poll on LinkedIn this week about how positive people were still feeling after the budget, and 77% of the 200 plus contributors suggested they were as hungry as ever to start and develop more successful businesses. The entrepreneurial spirit has not been quelled or crushed by the negative messaging that's out there. I'd also remind everyone that if my other contention is right around inflation, and we live in a world closer to 3% than 2%, without much action being taken, this is a fabulous thing for investment property. Prices go up more, rents go up more, nominal debt decays further and faster. If it lasts a decade, and it could be longer, that's a fabulous result. Now, the downside case to that scenario is interest rates have to stay higher. So we do need to also bear in mind, obviously it depends on how much leverage you use apart from anything else, but we do need to bear that side of the coin in mind as well. Now, there will be shocks along the way, there always are, but the base case to me looks as good as ever, regulatory frameworks aside. And I appreciate you might feel you can't just necessarily cast them aside, but I'm solely talking about the economics here rather than the regulatory. So this week saw the most bearish news alongside my increasingly contrarian viewpoint on all of this. I know there's plenty of portfolio landlords that agree with me, and the larger operations and fewer of them is the future of this game. The NRLA caused a stir this week by releasing their survey data, and be careful on intentions versus actions. We need to measure both, but intentions don't always lead to actions, especially in property it seems. The survey said 41% of landlords plan to sell at least some rental properties, with just 6% saying they would buy. Now, if the 6% look like me, and the 41% look like an average NRLA member, that balance might not be anywhere near as bad as it sounds. However, as I've said over the past few weeks, I'll still be buying fewer than I would have done had the stamp not moved from 3% to 5%. That's just how economics and taxes work. Some vendors won't be able to accept that extra 2% off, and on some good stuff I'll pay an extra 1% or maybe even the 2%, but I certainly won't be doing that across the board, because that's not how business works. So, only 1 in 8 renters can afford to be able to buy in the area they rent in, and so this government is really continuing the same vein as the previous one, in a trend that's now 9 years old. They're making things harder for renters, and whilst they're appearing to care with their Renters' Rights Bill, it doesn't care about the inevitable economic impact on the renters. The only solution is buying or maintaining stock in areas where there's likely to be decent capital growth and rent growth, and therefore there's affordability. We will be fine. The consumers, not so well off in my view. So where do rates go now in the medium term? Well, down even more slowly than I've said in the past in my view. I think we're looking at 2 cuts in the next 6 months and then a stall. We might even have a surprise hold at some point, which once again spikes the bond yields, if and when they come down a bit from here. As at today, base rate going below about 4.25 looks hard to justify even over the next 9 to 12 months, to be honest with you. If we lose some more economic steam, unemployment moves up to 4.6 or 4.7 or 4.8, savings rates stay high with growth down in the doldrums of basically break even once again, there might be noises about trying to cutting and keeping the economy limping forwards. It's not what we want, but if it happens, then rates will go down. But just be careful what you wish for. We then, as a more nuanced point that I've been making, may well lose more units to temporary accommodation. The noble cause of getting people out of terrible B&Bs nevertheless removes units from the PRS, and it's almost a problem without a solution. Who deserves it more? It's difficult to say, because the brutal reality is that it depends why you're in temporary accommodation. Asylum has the same issue, and that's why the government is struggling to do what it said it was going to do when it was in opposition with some of the bigger asylum centres. All of this sucks more and more units out of the vanilla PRS. The direction of travel is ugly for renters and very little is improving, and we aren't at the bottom, in my view. I'll grow my portfolio, that's a guarantee, but I might not grow the PRS element of it. Leases to providers are more attractive from a service perspective, have an investment case, they've got more social purpose behind them. I care about all of those things. The PRS in itself, and please don't confuse that with investment property, because it's a very important distinction to make, and it's one you're going to hear me make more and more as time goes on. But the PRS itself has very little to recommend it at the moment. That leaves us with Mansion House then. The Mansion House speech is a State of the Union address about the state of the British economy, delivered by the Chancellor, who was a bit embarrassed by Friday's growth figures, of course. Luckily for her, Mansion House speech was on Thursday. Reeves tried to buy a few friends with promises to cut red tape in the city to encourage risk-taking. Rhetoric that would have been enjoyed. There was the odd headline about a return to casino banking, which is unlikely, but also some pointing out the net zero impositions on the city are the opposite of less red tape. It does seem to be one more disconnect between the rhetoric and the policy, which is just making this government look inept so far, and that really should be the biggest worry of all. It isn't like we haven't had inept administrations in recent times. One particular salad ingredient comes to mind, of course, but what about the guy with the hair? But we were promised better, and we aren't getting it right now. We're getting better than some of the worst we've had in recent times, but only just. Even for all of Sunak's weakness and lack of spine, Sunak and Hunt were miles better than this. So Reeves assured us that economic growth is at the heart of everything. Well, she's right, but you've got more chance of achieving that by drill, baby, drill, than by arbitrary and misguided net zero policies. And I'm afraid that's just an economic fact. We need to get on with these small modular reactors and stop messing about. Stability, she once again wheeled out. I could buy this, but stably bad is probably as bad as erratically okay. Investment, we've had a bit promised now. It's started, nowhere near as much as we need, but there is a rock and a hard place. No growth, no investment. No investment, no growth. Chicken and egg. She's borrowed what she feels she can borrow, and even that has put 50 or 70 basis points on the debt, which is about 12.5 billion a year in debt costs as debt rolls over and breaks out, all else being equal. Then we've got reform. Now that's with a small r. That's a third wheel of her cart. Not a great choice of wording in my view, but nonetheless, reform so far is favouring the people. Very Labour, what you'd expect, but is it growth inducing? Not at this time. Margins are cut, people will lose jobs, not gain them. Expect hiring freezes and negativity around employment until 2026. Don't get me wrong, there have been mistakes, but not mistakes so large as to send us into recession, although we might be flirting with 0% growth for Q4. On that subject, NISA, the National Institute for Economic and Social Research, whose real-time forecasting I do respect, still see 0.3% growth for Q4 2024. I think no chance now, because October's a write-off, or a step backwards, and I'll reserve judgment until we see November's PMIs, but I don't see much more than a 0 or a 0.1, and we could print a minus 0.1. Wouldn't be a huge surprise. Remember, inflation's going to be going back up, so that's going to make real growth even more difficult than it already is, with a limp October to kick us off, and then a bad news budget. There was then an emphasis in the speech that the budget was a once-in-a-parliament budget to wipe the slate clean. Many think she can't really stick to this, but remember, it was a biggie, the biggest in tax revenue rises for 30 plus years. This will be adhered to unless there's yet one more crisis, I think, but that's not the same as tax not going up for the rest of the Parliament. She emphasised again and again this is all about growth. I've set out my case, which is very much housing related, as you'd expect, and be more about luck than judgment. Unfortunately, some economic illiterates like Sadiq Khan go around suggesting that lower house prices might lead to economic growth. Has he been on the phone to Kwarteng or something? And by disadvantaging private renters, which is absolutely what every shred of policy is doing at the moment. They must be hoping that all the boost comes from the homeowners, is all I can think. One of the big problems with that is a decent slug of the homeowners are retired, of course, but there you go. She referenced her time at the Bank of England, which sadly she seems to have chosen to fluff up a bit alongside her career in financial services, which turns out not to be what she talked it up to be. This is concerning because this is the sort of puffery you'd expect from a property guru, not from the Chancellor of the Exchequer. Do better, Rachel, and tell the truth. Hopefully it's a lesson now learned. We all recall things differently sometimes, but we need less sizzle and more sausage, please. Reeves did nail the fact that we need the best financial services in order to export them. Reference that we're weak on IPO, without saying it, and need to attract more in a field in which we are really struggling in quite an embarrassing way these days. 5 services were referenced for focus in the government strategy: fintech, sustainable finance, asset management and wholesale services, insurance, and capital markets. This is going to be developed and released in the spring. Let's wait and see how good it is. She wants significant private investment from the city for net zero. Of course, it will only work if there are returns for those putting the money in. Usually guarantees will be wanted, and firms and funds will accept some quite meagre returns that we wouldn't get out of bed for, because we're not capital allocators as a rule, we're wealth creators. Then we had the pension shake-up rhetoric once again. Reeves wants fewer, bigger pension funds with lower cost bases, which in itself makes a lot of sense. Let's see how it actually plays out. She also wants pension funds to invest in startups, which makes no sense in the environment of 4% plus gilt yields. They don't need to. She's barking up the wrong tree here, in my opinion. This is great rhetoric when interest rates are zero. So how will this happen? Infrastructure? Energy assets? Well, sure, that makes sense, especially when returns are guaranteed and beat gilts. But startups? Not for me. She then talks about Australian pension fund investment in private equity. Sure, again, if returns are highly well protected or likely to be very high because they're employing a professional company that's going to burn out on some investments but make big returns on other investments, buy a massive company with no debt that can carry the debt and all's good. If not, you have an Asda style situation. Anyway, there's a pension scheme bill coming next year and it will be interesting. Overall, I think she's on the right lines, but claiming there's an extra 80 billion of extra investment to unlock by doing this really sounds like she's quoting the very best case scenario. Then there's the attempt to butter up Mr. Trump that the Labour Party are internally absolutely hating, of course. I do think the press have largely been unfair quoting what's been said by the likes of Lammy when Mr. Trump's own Vice President called him America's Hitler, and many other members of his administration have made even more ad hominem attacks over the time. For example, Marco Rubio, and have still landed a top job. I very much doubt Mr. Trump remembers or cares. If he kept a black book of everyone who'd slagged him off, it would be bigger than the Encyclopedia Britannica, and the thickness of his skin makes a rhino look oversensitive. Then there were assurances over sensible spending of funds in the NHS. Let's see. And details of digital investments and tech that do sound exciting, as long as they work, and are delivered on time and on budget, which never happens, of course. Overall, I think the city received it well, but Reeves now really has to deliver and prove herself rather than spending time fluffing up what she did before she got to number 11. We don't need to care at this point. She's there, and the finances of the country will live and die by her leadership. She strikes me as a pretty decent chess piece in a pretty limp board at this time, and I hope she digs her heels in, because she's a lot stronger than the rest of them. My worry is that's a bit like being taller than me, and I come in at a mighty 5'6.5". Not a huge achievement. So before I call it one more time, a reminder that tickets for the next Property Business Workshop are out. Thursday, January the 16th, 2025, Wowsers, with some great subject matter: planning, efficiencies, financial accounting and bookkeeping. Not how to use Xero, but how to ensure reporting is set up correctly and how to monitor it on an effective, ongoing monthly basis. Come along and also get your strategic planning sorted out, and your January kick up the backside comes as part of the package as well. Super early bird tickets are available with a 25% plus face value discount on them. Once they're gone, they're gone. There's about half a dozen left. These events do sell out. Rod and I hope to see you there. Buy one at bit.ly/PBWFIVE. And we all know there's only one way to deal with this ongoing noise and excitement. Keep calm, always read or listen to the supplement, and carry on. Thanks everyone.